If you're an incorporated business owner or professional in Canada, you've probably been told your RSP is the cornerstone of your retirement plan. And for many people, that's true, up to a point. The issue is that as your income grows and you get closer to retirement, RSPs start to show their limits. The contribution caps feel restrictive. You're sitting on retained earnings in your corporation, wondering how to move them out efficiently, and you're looking for a way to save more for retirement while lowering your corporate tax bill at the same time. This is where most advisors stop. But there's another tool very few business owners even know exists. It's called an individual pension plan, or IPP, and it's like an RSP upgrade for high-income business owners over 40. Bigger tax deductions, larger contribution room, and more secure retirement income. So how does it work? And is it right for you? Let's break it down. Hi, I'm Stefano Francesca, certified financial planner professional at Next Step Wealth Management with IPC Securities Corporation. If you find this helpful, don't forget to like, comment, and subscribe. Want more information or want to know how this can work for you? Make sure to book a call with me using the link in the description below. What is an IPP and why should business owners and incorporated professionals consider one? If you're a business owner in Canada, chances are you've already been using your RSP as your main retirement savings vehicle. And for good reason. It's a great way to defer tax and grow your wealth over time. But what if you've already maxed out your RSP? Or you're earning enough through your corporation that you wish you could contribute more? This is where the individual pension plan, or IPP, comes in. Think of it like a supercharged RSP, designed specifically for high-income incorporated business owners and professionals. Here's the distinction. With an RSP, everyone is capped at the same contribution limit, which for 2025 is $32,490. But with an IPP, the allowable contribution room increases as you get older. For example, let's say you're 55 and have significant T4 income from your corporation. Your RSP contribution room is still limited to the annual maximum I just mentioned, but an IPP could allow your corporation to contribute significantly more. In 2025, you'd be able to contribute $47,000 or 45% more. If you were 65, you could set aside 67% more in your IPP than in an RSP. That's a massive advantage if you've fallen behind in retirement savings or simply want to maximize the tax-sheltered growth on your investments. As well, this allows you to remove passive assets within the corporation to a tax-sheltered strategy. And here's the kicker. Those contributions are made by your corporation and they're fully deductible as a business expense. For business owners, this could mean your company or your practice reduces its corporate tax bill while boosting your personal retirement plan. How is an IPP different from an RSP? At first glance, an RSP and an IPP might seem similar. They both help you save for retirement in a tax-deferred manner, but there are some key differences you need to know. Contribution limits. As I mentioned earlier, RSPs have fixed annual limits that apply to everyone under 71 years old. IPPs don't work like that. Contribution room grows as you age because the plan is designed to fund a fixed pension for your retirement. Who makes the contributions? With an RSP, you personally make the contributions and get a tax deduction. With an IPP, it's your corporation that makes the contributions and the deduction applies to the corporate tax return. Creditor protection. This is a big one for business owners. The Bankruptcy and Insolvency Act protects RSPs from seizure by creditors in bankruptcy, with the exception of recent contributions. However, creditors still can seek a court order against a debtor who has not declared bankruptcy. RSPs are definitely vulnerable in the case of litigation. IPPs, on the other hand, are generally protected from creditors in bankruptcy and through litigation. So if you face legal action or bankruptcy, your IPP assets are typically safe. Costs and complexity. RSPs are simple. You open an account, you contribute and invest. IPPs are more complex. They require actuarial calculations and have setup and ongoing administration costs. But for high-income business owners, the benefits often outweigh these costs and complexities. Who's a good fit for an IPP? An IPP isn't for every business owner or professional. So how do you know if it's the right tool for you? Here's a quick checklist. You're 40 or older. Why? Because the older you are, the greater the contribution advantage over an RSP. For someone in their 30s, an RSP and an IPP offer similar limits. But starting in your 40s and beyond, the IPP starts pulling ahead. You have consistent T4 income of $100,000 or more. The IPP is based on your T4 earnings from your corporation. So if you're paying yourself primarily in dividends, this strategy won't work unless you restructure your compensation. You've maxed out your RSPs and want to do more. If you've been diligent about saving and now want to increase your tax-sheltered retirement contributions, an IPP can open that door. You're looking for creditor protection. If you're in a profession or business with liability exposure, doctors, lawyers, contractors, an IPP adds another layer of security around your retirement assets. You're thinking long-term. As this is a company-sponsored plan, it's best suited to business owners who plan to maintain their corporation and income for the foreseeable future. If this sounds like you, it's an option worth exploring. Are there downsides to consider? Like any advanced planning strategy, IPPs come with trade-offs. Setup and administration costs. An IPP isn't free. You'll need an actuary to set up the plan and perform calculations, plus a trustee to hold the funds. Expect to pay a few $1,000s initially and ongoing annual costs. These costs are deductible to the corporation, however. Funding obligations. It used to be that once you set up an IPP, your corporation was obligated to fund the plan on a regular basis. Recent changes in most provinces have now exempted IPPs from the forced funding rules, thus reducing that barrier, so unused contribution room can be carried forward and deducted by the corporation in a future year. More oversight. As these are actual pension plans, they need to be registered and governed accordingly, and as such, there are more reporting requirements. Withdrawal flexibility. The annual or monthly withdrawal amount is determined by the IPP's pension formula. There's no option to selectively choose the withdrawal amount on a year-by-year basis as long as the IPP is in existence. An individual should have other assets to provide greater flexibility in their retirement income and to provide variable spending. It's also worth noting that a business owner can collapse an IPP and transfer all eligible amounts to a LIRA, thus creating an opportunity in the future to unlock funds for more flexible retirement withdrawals. That's why it's critical to work with a financial planner, accountant, and actuary that understand IPPs. The right team can integrate the plan into your corporate and personal financial strategy without surprises. For many high-income business owners and incorporated professionals, these downsides are far outweighed by the tax advantages and larger retirement benefits, but it's not a decision to rush. Why this could be the upgrade you need. If you've built a successful business, you're probably already thinking about how to extract money from your corporation tax efficiently in retirement. And this is where an IPP shines. It allows your corporation to make larger tax-deductible contributions on an annual basis for current service. Your corporation can fund a large lump sum contribution for past service prior to the setup of the plan, thus allowing the catch-up on previous higher limits. It creates a structured, predictable retirement benefit, and it helps you convert business income into a personal retirement plan while protecting assets from creditors. Finally, it can help purify your corporation by removing passive assets in order to qualify for the lifetime capital gains exemption. Think of it like moving from a do-it-yourself savings account to a fully integrated pension plan funded by your own company. For business owners and professionals who are within 20 years of retirement, this could be the missing link between where you are now and where you want to be. If you're a Canadian business owner or incorporated professional and you're over 40 with consistent T4 income, an individual pension plan could be the upgrade your retirement strategy needs. IPPs can offer a more advanced, tax-efficient tool that can help you save more, protect your assets, and give your corporation additional tax deductions along the way. But like any strategy, an IPP isn't a one-size-fits-all. It has to fit your specific situation. It has to fit the stage of life you're in, the health of your corporation, and your long-term retirement goals. Now, there's much more to discuss about IPPs than what we've spoken about in this video. The worst mistake I see is business owners waiting too long to explore options like this. The earlier you understand how an IPP fits into your plan, the more flexibility you'll have later. If you don't plan properly, you could end up leaving tax savings on the table and limiting how much you're able to draw from your corporation in retirement. If you're a Canadian business owner or incorporated professional and looking for a higher level of expert advice, click on the link in the description to book a consultation. We work with clients to look at your numbers and help you understand whether an IPP makes sense, or if there are other ways to pull money out of your corporation tax efficiently. The earlier you start, the more options you'll have. Let's take the next step.